Welcome to Sophie Daddy's channel. When we think about retirement, we usually get laser focused on one thing, right? That big savings number. But what about the risks that can totally blow up your plan, no matter how much you've saved? Well, today we're going to pull back the curtain on those complex insurance products that are sold as the ultimate safety net. We're going to find out what they're supposed to protect you from, and more importantly, what they really cost. Okay, so here's our game plan. First, we're going to pinpoint the 3 huge financial risks you face in retirement. Then we'll dive into the 2 main insurance solutions people use, annuities and long-term care policies. After that, and this is the juicy part, we're going to calculate the hidden price tag of these guarantees. And finally, we'll run through a decision-making guide to help you figure out if any of this makes sense for you. So, to really get the solution, you have to understand the problem first. And these products, they exist to fight these giant financial challenges that are pretty much out of our hands, but can absolutely wreck our retirement dreams. All right, the first risk, and honestly the biggest one, is just living a long time. I know, that sounds like a great problem to have, but financially it creates this nagging uncertainty. With old school pensions basically extinct, it's all on you to make sure your savings last for who knows how long. 20 years? 30? 40? That's longevity risk. That big question, will my money last as long as I do? The second risk is all about bad timing. Just picture this. You retire, you pop the champagne, and then the market crashes. Ugh. Now you're forced to sell your investments when they're at their lowest point, just to pay your bills. And that can permanently cripple your portfolio's ability to grow back, even when the market eventually recovers. It's not about your average return over 30 years. It's about getting hit with bad luck right at the start. It's just devastating. And the third giant risk? Healthcare. Specifically, the kind of care that your health insurance and even Medicare typically will not cover. That number you're looking at right there, that's the median cost for just 1 year in a nursing home. An expense like that, year after year, can literally make a lifetime of savings go up in smoke. Okay, so how do you fight back against these risks? Let's check out the first solution on the table. To deal with that fear of running out of money, the insurance world came up with annuities. You can think of them as a contract that lets you build your very own private pension plan. Now, annuities come in a few main flavors. A fixed annuity is the simplest. It's kind of like a CD from an insurance company. A variable annuity is more like your 401k. It lets you invest in different funds for higher growth potential, but yeah, it also comes with market risk. And then there's the indexed annuity, which tries to be the best of both worlds, tying your returns to an index like the S&P 500, but with some caps and limits on how much you can earn. But here's where you really need to look under the hood. This slide shows us the hidden cost. A variable annuity isn't just a simple investment. You've got the fund expenses, sure, but then there are all these insurance costs layered right on top. That mortality and expense charge, that's the direct price you pay for the insurance features. Tack on some admin fees and maybe some extra bells and whistles, and you're looking at a total drag on your performance of over 3.5% every single year. Now, let's talk about that second huge risk, those crushing healthcare costs. The solution here is long-term care insurance. It's designed to be a shield, basically, to protect all the money you've saved from getting completely wiped out by an extended medical situation. And don't for a second think this is some rare, unlikely event. According to the government, 56%, yep, more than half of us turning 65 today, are going to need some form of long-term care. This isn't a what-if scenario. It's a statistical probability that really has to be part of any serious retirement conversation. And this chart just brilliantly shows why you can't just kick this can down the road. Just look at the difference in what you'd pay every year if you bought a policy at 55 versus waiting until 65. For a man, the premium jumps by 51%. For a woman, who statistically lives longer, it's a 42% hike. Waiting has a very real and very expensive price tag. But it's not just about the money. As you get older, your chances of even qualifying for insurance plummet. They look at your health, and as this chart shows, the denial rate just climbs and climbs, hitting an incredible 47% for people applying in their early 70s. That window of opportunity to get covered, it doesn't stay open forever. So we've seen the risks and the products designed to fix them. But now we're at the most crucial part of this whole explainer, figuring out the real price you pay. Not what's on the bill, but what you lose in potential growth. All for the security these products are promising. This bar chart, it just makes the trade-off crystal clear. Let's say you invested $100,000 for 20 years. In a simple, cheap S&P 500 index fund, it could grow to over $500,000. Pretty great. But that same money inside a typical variable annuity, after all those layers of fees get scraped off the top, it grows to just over $350,000. That difference is absolutely staggering. So what is that number? That $205,000 difference? That's not a flaw in the product. It's the price tag. It is the explicit, quantifiable amount of growth you gave up over 2 decades in exchange for the annuity's guarantees. I love this quote because it completely reframes the whole debate. When you buy one of these products, you are actively choosing to buy certainty by selling off a chunk of your potential growth. That underperformance, it's the feature, not the bug. The real question is whether that trade is worth it for you. Okay, so how on earth do you figure out if these trade-offs make sense for your life? Let's walk through a simple framework. And just to be super clear, this isn't financial advice. It's just a way to think through the logic of who these products are really designed for. So as this table shows, a lot of it comes down to your net worth. If you have fewer assets, paying for something like long-term care insurance can be really tough, and you might end up relying on government programs like Medicaid anyway. On the flip side, if you've got over, say, $2 million, you can probably self-insure, meaning you can pay those huge bills out of pocket without it destroying your finances. The real sweet spot for these products is often for the folks in the middle, people who have enough money that it's worth protecting, but not so much that a disaster wouldn't hurt them badly. And that really brings us to the final question, doesn't it? There is no one-size-fits-all answer here. It's a deeply personal choice that's part math and part emotion. The data clearly shows that security has a price, and that price is lower potential returns. So the question you have to ask yourself is this: how much is your peace of mind really worth?
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.